Question 11. Instead of CIBR, would it be more beneficial to invest in individual cybersecurity stocks to potentially achieve higher returns? Choosing between CIBR, a cybersecurity ETF, and individual cybersecurity stocks involves a trade-off between diversification, potential returns, risk, and management effort. Here's a breakdown to help you decide. Potential benefits of individual stocks. Higher returns. Individual stocks, particularly in a high-growth industry like cybersecurity, can potentially generate significantly higher returns compared to an ETF like CIBR. This is because successful stock picking can lead to amplified gains. Greater control. By selecting individual stocks, you have more control over your investment portfolio and can tailor it to your specific risk tolerance and investment goals. You can choose companies with specific growth potential or focus on certain subsectors within cybersecurity. Challenges of individual stocks. Higher risk. Investing in individual stocks carries a higher risk compared to ETFs. The performance of a single stock can be more volatile and susceptible to company-specific risks or negative industry events. Lack of diversification. Building a diversified portfolio of individual cybersecurity stocks requires significant research, time, and ongoing monitoring. Owning just a few companies exposes you to greater concentration risk than a diversified ETF, like CIBR. Management effort. Effectively researching, selecting, and monitoring individual stocks requires substantial effort and ongoing analysis of the cybersecurity industry and individual companies. Benefits of CIBR ETF. Diversification. CIBR offers instant diversification across dozens of cybersecurity companies, reducing your exposure to the risk of any single company underperforming. Lower risk. Due to diversification, CIBR's overall volatility might be lower compared to a portfolio of individual stocks. Lower management effort. Investing in CIBR requires less research and management effort compared to selecting individual stocks. Challenges of CIBR ETF. Capped returns. CIBR's performance is capped by the underlying index. While it can outperform during strong market periods for cybersecurity, it might underperform if actively managed funds or individual stock pickers outperform the broader market. Limited control. With CIBR, you have less control over the specific companies within your portfolio. The ETF's holdings are determined by the underlying index. Making an informed decision. The best choice depends on your risk tolerance, investment goals, and resources. For higher risk tolerance and active management, if you have a high risk tolerance, the time and resources to research individual stocks, and aim for potentially higher returns, then investing in individual cybersecurity stocks might be suitable. For diversification and lower risk, if you prioritize diversification, lower risk, and a more hands-off approach, then CIBR or a similar cybersecurity ETF might be a better option. Alternative approaches. Hybrid approach. Consider a combination of CIBR for core cybersecurity exposure and a few well-researched individual stocks for potentially higher returns. Thematic ETFs. Explore thematic ETFs targeting the broader technology or growth sectors, which might have some overlap with cybersecurity companies. Question 12. How does CIBR compare to broader technology ETFs that may also have exposure to cybersecurity companies? CIBR, the first trust Nasdaq cybersecurity ETF, offers targeted exposure to the cybersecurity sector, while broader technology ETFs provide a more diversified mix of technology companies, potentially including some cybersecurity firms. Here's a breakdown to understand the key differences and how they might impact your investment strategy. Investment focus. CIBR focuses specifically on cybersecurity companies, aiming to capture the growth potential of this industry. Broader technology ETFs Examples include the Technology Select Sector SPDR Fund, XLK, or the Vanguard Information Technology ETF, VGT. These ETFs invest in a wider range of technology subsectors, such as semiconductors, software, hardware, and potentially some cybersecurity companies. Exposure and diversification. CIBR offers concentrated exposure to cybersecurity, increasing your potential returns if the industry thrives but also magnifying potential losses if the industry faces challenges. Broader technology ETFs provide diversification across various technology subsectors, potentially mitigating some risk compared to CIBR. However, the level of cybersecurity exposure within these ETFs might be lower. Performance. CIBR can potentially outperform broader technology ETFs during periods of strong growth in the cybersecurity industry. However, its performance might be more volatile and lag behind broader technology ETFs during periods when other technology subsectors outperform. Broader technology ETFs, historical performance can vary depending on the specific ETF and its holdings. Generally, they might offer smoother returns due to diversification but might miss out on the concentrated growth potential of the pure cybersecurity play offered by CIBR. Fees. CIBR expense ratios for cybersecurity ETFs like CIBR might be slightly higher compared to some broader technology ETFs due to the more specialized focus. Choosing between CIBR and broader technology ETFs. The best choice depends on your investment goals and risk tolerance. For targeted cybersecurity exposure, if you're bullish on the cybersecurity industry's long-term growth potential and are comfortable with higher risk for potentially higher returns, then CIBR might be suitable. For diversification and lower risk, if you prefer a more diversified technology exposure with potentially lower volatility and are comfortable with potentially lower returns from the cybersecurity sector, then a broader technology ETF might be a better choice. Additional considerations. Specific technology subsectors. Some technology ETFs might have a tilt towards specific subsectors like semiconductors or software. Research the holdings of any broader technology ETF before investing to understand its exposure to cybersecurity. Actively managed versus passively managed. Some technology ETFs are actively managed, meaning the portfolio manager selects holdings. This can potentially lead to higher returns, but also comes with higher fees. Question 13. Are there any cybersecurity mutual funds with lower expense ratios or potentially better risk-adjusted returns than CIBR? Yes, there are potentially some cybersecurity mutual funds with lower expense ratios or better risk-adjusted returns than CIBR. First Trust Nasdaq Cybersecurity ETF. Here's a breakdown to help you compare. CIBR ETF. Expense ratio. Consider CIBR's expense ratio as a benchmark. Typical expense ratios for CIBR might be around 0.60% annually. Cybersecurity mutual funds. Lower expense ratios. Some actively managed cybersecurity mutual funds might have slightly lower expense ratios compared to CIBR. However, expense ratios typically range from 0.50% to 1.0% or even higher for actively managed funds. Potentially better risk-adjusted returns. Actively managed cybersecurity mutual funds, with skilled portfolio managers, aim to outperform the benchmark, CIBR in this case, by selecting undervalued companies or employing specific investment strategies. This can potentially lead to better risk-adjusted returns, meaning higher returns relative to the level of risk taken. Challenges of mutual funds. Minimum investment. Mutual funds often have minimum investment requirements, which can be a barrier for some investors compared to ETFs like CIBR with lower entry points. Actively managed risk. The success of actively managed funds relies on the portfolio manager's skills. Their investment decisions can significantly impact the fund's performance, and underperformance is a possibility. Less transparency. Mutual funds might not disclose their holdings daily like ETFs, making it slightly less transparent for investors to understand the fund's composition. Finding suitable mutual funds. Financial websites. Several financial websites allow you to compare mutual funds, including those focused on cybersecurity. You can filter by expense ratio and investment objective. Investment research reports. Investment research firms might publish reports analyzing actively managed cybersecurity mutual funds and their performance compared to benchmarks. Important considerations. Past performance. Past performance is not a guarantee of future results. Just because a mutual fund outperformed CIBR historically doesn't guarantee it will continue to do so. Fees and expenses. While expense ratios might be slightly lower than CIBR, actively managed funds still have fees. Carefully compare expense ratios and understand the overall fee structure of any mutual fund before investing. Investment strategy. Research the investment strategy of a cybersecurity mutual fund before investing. Understand the manager's approach and risk tolerance to ensure it aligns with your own investment goals. Alternatives to consider. Lower cost broader technology ETFs. If a lower expense ratio is a priority, explore broader technology ETFs with some exposure to cybersecurity companies. Hybrid approach. Consider a combination of CIBR for core cybersecurity exposure and a lower cost broad technology ETF for additional diversification. Question 14. What are the potential benefits and drawbacks of thematic ETFs like CIBR? Thematic ETFs like CIBR offer exposure to specific themes or industries, in this case, cybersecurity. Here's a breakdown of the potential benefits and drawbacks to help you decide if a thematic ETF like CIBR aligns with your investment goals. Benefits. Targeted exposure. Thematic ETFs provide concentrated exposure to a specific theme or industry, allowing you to capitalize on potential growth opportunities within that sector. For CIBR, this means focused exposure to the growing cybersecurity industry. Convenience and diversification. Thematic ETFs offer instant diversification within a chosen theme, eliminating the need to research and select individual stocks. CIBR, for example, provides exposure to dozens of cybersecurity companies, reducing your concentration risk compared to picking a few individual stocks. Lower costs. Thematic ETFs typically have lower expense ratios compared to actively managed funds targeting a similar theme. CIBR, for instance, has a competitive expense ratio compared to some actively managed cybersecurity mutual funds. Transparency. Thematic ETFs, like CIBR, typically hold their holdings transparently, allowing investors to understand the underlying composition of the ETF. Drawbacks. Concentration risk. While thematic ETFs offer some diversification within a theme, they are still more concentrated than broad market ETFs. CIBR's performance is heavily tied to the cybersecurity industry's performance. If the industry experiences a downturn, CIBR's value might decline significantly. Limited control. With thematic ETFs, you have less control over the specific companies within your portfolio. The holdings are determined by the underlying index, and you cannot choose individual companies. Limited diversification. Compared to broad market ETFs, thematic ETFs offer less overall diversification. This can expose you to greater risk if the chosen theme underperforms. Potential for overvaluation. Thematic ETFs that gain popularity can attract significant investment flows, potentially leading to overvaluation within the holdings. Suitability of thematic ETFs. Thematic ETFs like CIBR might be suitable for investors who Believe in a specific theme. If you're bullish on the long-term growth potential of the cybersecurity industry, CIBR could be a way to gain exposure. Seek diversification within a theme. CIBR offers diversification within cybersecurity compared to picking individual stocks. Prefer lower costs. Thematic ETFs typically have lower expense ratios compared to actively managed funds targeting similar themes. Alternatives to consider. Broad market ETFs. For broader diversification across various sectors, consider ETFs that track major stock market indices. Actively managed funds. Actively managed funds targeting technology or growth stocks might have some overlap with cybersecurity companies, but offer more flexibility in holding selection. However, they typically come with higher fees. Alright everyone, that brings us to the end of our deep dive into the CIBR Cybersecurity ETF. We explored the potential benefits of targeted exposure, built-in diversification, and potentially lower costs compared to actively managed funds. However, we also discussed the concentration risk of being heavily tied to the cybersecurity industry, the lack of control over individual holdings within CIBR, and the potential for overvaluation in thematic ETFs. No matter your choice, remember, thorough research and aligning your investment strategy with your risk tolerance are crucial. Thanks for joining the chat on CIBR. Leave a comment below with your thoughts on cybersecurity investing, and let us know what other ETFs you'd like us to explore next. Don't forget to like this video and subscribe to Chat ETF for more in-depth discussions about the exciting world of exchange-traded funds.